Have you ever considered what happens when life throws an unexpected curveball and you need cash quickly from your investments? Or perhaps market conditions suddenly shift, making it hard to sell certain assets without taking a major hit. Understanding this challenge is key to resilient investing. Managing liquidity risk in your investment portfolio means ensuring you can convert your assets into cash when needed, without incurring significant losses or disruption. It is about carefully balancing potential returns with your immediate ability to access your money. This risk arises because not all investments are equally easy to sell. Illiquid assets, such as real estate or some private equity holdings, can tie up capital for extended periods. If you are forced to sell them quickly due to an emergency or a sudden market downturn, you might have to accept a much lower price than their intrinsic value, potentially eroding your capital and derailing your financial plans. A primary strategy is to diversify your holdings across assets with varying liquidity profiles. This means including a mix of highly liquid assets, such as cash and money market funds, alongside moderately liquid assets like publicly traded stocks and bonds, and carefully considering the proportion of less liquid investments. Maintain an adequate cash reserve to cover short-term needs, which acts as a buffer against unexpected expenses. Furthermore, it is crucial to understand the liquidity characteristics of each investment before committing capital. For fixed income portfolios, consider staggering bond maturities to ensure a regular flow of maturing principal that can be reinvested or used for liquidity. Also, assess the trading volume and bid-ask spread of individual stocks or exchange-traded funds. Lower volume and wider spreads often indicate reduced liquidity. Consider establishing a pre-approved line of credit or a margin account for contingency funding, though these should be used judiciously and understood fully. Regularly review your personal cash flow needs and your portfolio's liquidity to ensure it aligns with your evolving financial situation and potential future obligations. This proactive approach allows you to react to market changes from a position of strength rather than desperation. An insightful concept here is the liquidity premium, which suggests that investors often demand higher returns for holding less liquid assets to compensate for the inability to easily convert them to cash. Recognizing this helps you assess if the potential reward truly justifies the illiquidity risk. Another is asset liability matching, where you align the liquidity of your assets with the timing of your liabilities. By systematically managing liquidity risk, investors can protect their capital, maintain financial flexibility, and achieve their long-term financial goals with greater confidence. It transforms potential vulnerabilities into strategic advantages, ensuring you are prepared for both anticipated and unforeseen financial demands.